Hey friends, it's Iggy here. Let's walk through this together. Because most investors are seeing Lendlease REIT's possible PLQ Mall deal as just another acquisition. But the bigger picture is way more interesting. The simple version, if Lendlease ends up with full control of PLQ Mall, this isn't a sidestep. It's a portfolio shift that could unlock value over the next few years. And that's what we're unpacking today. Here's the plan for this video so it mirrors the Substack article exactly. First, we'll hit the main hook. Why this move matters more than it looks. Then we'll go section by section. The strategic portfolio transformation. The stronger balance sheet after the gem divestment. Why PLQ Mall is a suburban gem. The market context for retail REITs. The risks that actually matter. The buy, have, a hold/sell call. The local investor considerations. The broader sector implications. And finally, some practical next steps. If you're new here, I've spent years breaking down investing in Singapore, so you don't have to stress. Let's make this clear, calm, and actionable. So first up, the hook. A lot of folks focus on yields and headline occupancy. That's fine. But the reason this PLQ Mall story stands out is that it creates a powerful combination. Prime Orchard Road exposure with 313 Edge at Somerset and resilient suburban exposure with PLQ. One anchors tourism and high street spending. The other anchors everyday, necessity-driven traffic. If you've ever tried to build a dividend portfolio that can weather cycles, that mix should ring a bell. Here's the question to sit with. Are we looking at a one-off purchase or a smarter way to compound rental growth across different demand drivers? That brings us to the strategic portfolio transformation. Right now, the shares trade at a discount to book value, roughly below 1x PNAV, which tells me the market still hasn't priced in the optionality in the assets. Imagine a simple table for a second. Price around the low 60 cents, target at 75 cents, forward yield about the mid 6% range, market cap in the mid billions. So what does that really mean for us? It means there's already a valuation cushion before any PLQ synergies show up. And when we say PLQ is over $1 billion in asset value with about 340,000 square feet of space and a strong transport node, we're not guessing. This is exactly the kind of scale that moves the needle. Here's the part I find especially important. Full ownership gives Lendlease control, leasing strategy, tenant mix, AEIs, the whole playbook. Control is how REIT managers create value over time. Now the transition. This isn't just buying more gross floor area. It's about creating that 1-2 punch. Orchard Road for brand and pricing power, suburban PLQ for daily footfall and defensive cash flow. And the timing helps. Retail REITs in Singapore are not in crisis mode anymore. Occupancies are high across quality portfolios. Rental reversions are back in the positives. Suburban malls led the recovery, with many exceeding pre-COVID sales. So the question becomes, if you could buy a REIT at a discount while it upgrades its portfolio quality and balance sheet, would you? Financial strength creates acquisition opportunity. Let's talk balance sheet, because this is what lets the strategy happen without breaking the ship. After selling down the gem office exposure, leverage drops from the 40s to the mid-30s, interest coverage improves, and cost of debt eases. Plain English, more headroom, less risk. Imagine another quick table. Leverage moves from about 42% to mid-30s. Interest coverage around 2 times, cost of debt mid-3% handle, and flexibility, this is key, goes up. Why does that matter? Because the number one reason REITs stumble after big deals is debt stress. If you can keep funding costs in check and avoid pushing gearing to the limit, you keep distribution stable while you integrate the asset. That's how you hold both the income and the upside. And yes, distributions. Distribution per share peaked in 2022, then drifted down as rates rose and cost pressures bit. But today, the forward yield is still attractive by local standards. The thing to watch is not just the quantum, but the path. If financing costs keep easing and PLQ brings steady rental growth, DPU doesn't need to jump. Stability plus gradual improvement is enough to re-rate a discounted REIT. Honest moment, I used to get tripped up by this too, chasing the highest yield on screen. What matters more is the engine behind the yield. PLQ Mall, the hidden suburban retail gem. If you've walked PLQ, you know the vibe. Commuter linked, daily spend, lots of food and beverage, services, and mass market retail. This isn't a high fashion trophy box, it's a reliable cash flow machine. Picture a quick asset profile in your head, roughly 340,000 square feet at Paya Lebar Central, tenants that fit daily needs, and the role in Lendlease's portfolio is clear. Be the suburban anchor that balances 313's prime retail cycle. So, what's the big implication? A portfolio that can keep earning in both a tourism upcycle and a domestic consumption baseline. That redundancy is what protects distributions over time. The strategic location matters. Direct MRT interchange means consistent footfall. That takes pressure off discretionary categories because a big chunk of spend is habitual. Groceries, quick dining, services, and tenant curation matters too. The mix at PLQ leans into necessity with enough lifestyle to keep dwell time up. For a REIT investor, that's code for low vacancy risk and steady reversions if managed well. Market context, why retail REITs are winning again. Let's zoom out. The retail REIT space here moved from recovery to modest growth. You've got positive rental reversions across good portfolios, high occupancy, and a limited new supply pipeline, so landlords have some pricing power again. Prime malls are riding tourism and luxury expansion. Suburban malls ride local wallets. Interest rates are moderating, which relieves financing pain. Does that guarantee cap rate compression? Not necessarily. But you don't need that if net operating income grows and the balance sheet de-risks. So ask, are we in a regime where the sector can deliver mid-single-digit total returns with lower volatility? If yes, then a discounted name improving its asset mix looks interesting. Risk assessment. What could go wrong? Let's be adults about this. Execution risk is real. Integrating a billion-dollar retail asset isn't a weekend project. Capital deployment risk is real too. Sizable commitment. And if sentiment turns, everyone suddenly loves dry powder. Market cycle risk. Consumption can slow, brands can consolidate, and a few quarters of weaker tenant sales can dent reversions. Interest rate risk. If cuts get delayed or credit spreads widen, funding costs can surprise. Now, how do we frame these? The mitigants are decent, a stronger balance sheet post-gem, a suburban-leaning tenant mix that's more defensive, and sponsor expertise in retail placemaking. In my experience, what matters most is discipline on leasing and AEIs. Small moves, done right, compound. Investment recommendation, strategic buy for patient capital. So should you buy, hold, or sell? Here's my honest take. If the thesis plays out, full control of PLQ, steady reversions, moderated funding costs, then a buy makes sense for patient investors with a 3 to 5 year view. The valuation discount offers a buffer, and the forward yield pays while you wait. If risk tolerance is lower, size it modestly. Think 3 to 5% of a broader S-REIT basket. If the acquisition terms come in rich or gearing gets stretched, downgrade to hold and reassess after the first year of integration. The key is not to expect fireworks in 6 months. This is a compounding, operate, and improve story. Critical considerations for Singapore investors. Quick local lens. For CPF or SRS income sleeves, the improved balance sheet and stable suburban exposure are the main positives. For tax, distributions from local REITs to individuals are generally not taxed, which boosts the real yield. Currency isn't a big issue here, given the core Singapore exposure. If a heavy overseas tilt shows up in future deals, then reassess foreign exchange and policy risk. But for now, the center of gravity is local. Strategic implications for the REIT sector. One step wider. This kind of deal signals a few things. Sponsor alignment remains strong. The market rewards quality portfolios over scattershot expansion. And scale matters because it improves tenant negotiation leverage and financing options. If more REITs lean into fewer better assets, we could see a healthier sector with less distribution volatility. That's good for all of us who rely on REITs for income. Actionable next steps for investors. If you're thinking about this name, here's how I'd approach it. First, monitor the acquisition terms. Price, structure, and funding mix will make or break accretion. Second, benchmark against peers. Are you getting similar yield and better growth, or paying up for the story? Third, map it into your portfolio. Do you already have suburban retail exposure? If not, this can be the anchor. If yes, avoid overconcentration. Complement it with a different segment like data centers or industrials to balance your income stream. And keep an eye on the next 2 quarters of leasing updates. Watch rental reversions, occupancy, and any asset enhancement initiative signals. By the way, if you want all the reference tables, the checklists, and the written version, everything's on Substack. The link's just below. That's where you'll find the numbers laid out cleanly and the peer comparisons you can screenshot for your own notes. Here's my honest take before we wrap. The market often undervalues boring resilience. PLQ is not a flashy story, it's a dependable mall in a great node. But dependable assets, paired with prudent funding, is how REITs recover, re-rate, and keep paying. If you remember one thing from this video, make it this. Buy quality cash flow when it's on sale, and give good operators time to do their work. So, if you're planning your next move, here's what I'd keep in mind. Look for control, balance sheet safety, and visible levers for rental growth. Size the position sensibly. And don't anchor on last year's distribution per unit. Anchor on the next 3 years of net operating income and funding costs. What are you looking at this month? Drop a comment with your top S-REIT pick and why. If you want early access to deep dives, model breakdowns, and member Q&As, consider joining the premium community on Substack. It keeps this channel independent and lets me spend time on the research that actually helps. And if this topic was useful, the next video to watch is my breakdown of retail versus industrial REITs in 2025. How to build a balanced income barbell. I'll see you there.